Welcome to Real Estate Today with Yvonne Candy. Learn how to invest in today's residential and commercial real estate. Get informed and get the latest news and trends. Whether you're an investor, home buyer, or homeowner, or just want to be entertained, you're in the right place. And here's your host, Yvonne Candy.
Have you ever wondered how much you have to put down on a house, or if you even qualify? Do you know there's other types of loans to choose from outside of your regular FHA and conventional? I know I've asked these questions. Well, my next guest, Alex Luboff, senior consultant from Prosperity Mortgage, will be telling you all about the different types of mortgages out there and how you can qualify. Hi, Alex.
Hey, Candy, how are you?
I'm doing great, thank you. How did you get into the lending business?
So when I was in college, I actually played hockey, and I was also a business student, so I graduated with a business degree. And I was, upon graduation, pursuing a career in hockey, and I decided to stop that pursuit and get into the business world. So at the time, the housing market was going pretty crazy, and it was really easy to get a mortgage, really easy to buy a home. And I knew a lot of people that were very successful in the mortgage industry, so I decided to jump right in, and I've been in that industry ever since.
Great. I know you've been into the business for a while now, Alex. What is the most common question people ask you?
So I think the most common question people ask me is, what is the interest rate? Whether it's somebody calling to get a rate quote, somebody calling to purchase a home, and on the initial conversation, or even in a social event at a party or a cocktail party, people are always just curious about what the rates are. But I really think oftentimes it's the wrong question when it's somebody calling me to shop for a mortgage or are interested in certain programs. There are so many different components that make up a monthly payment, and an interest rate is just one of them. So at times you can actually take a higher interest rate and also have a lower monthly payment with the elimination of things like private mortgage insurance. But aside from that, even so, I think the service execution of the loan officer is oftentimes more important than what the interest rate is. I do have people that select me over other companies, even if we have a higher interest rate at sometimes, and they get the better service, they get the execution, they know that they're going to close on time, they won't have moving trucks parked outside of the closing, wondering when they're going to be able to move into the house, which sometimes is worth a little bit more than an interest rate. On the flip side, having worked in a real estate office, I see the people who oftentimes may opt to go to another lender because of a lower interest rate, and they won't close on time. And it's one of those situations where they approach me and say, well, Alex, I wish I would have used you, had I would have known. So it's a difficult thing to say, I told you so, but it's an I told you so moment that really doesn't benefit anybody in the long run.
Right. It's always the terms in an agreement that is most important in the long run. And you do offer quality service. You're known for that. I know that myself. We were talking about the high-end client, and I thought that was very interesting, and I wanted the listeners to understand that there is a difference between a property that's priced at the lower end than a property is priced at the higher end. There is a difference in the mortgage loans. Can you sort of tell us about that?
Sure. So there's different types of price points that have different types of loans available. So if you have somebody who's looking at the lower end of the price point spectrum, there are more options to purchase the home with very little money out of pocket, because there's things like down payment assistance, there's things like grants that are available for certain income households or people that are looking in certain what are called underserved areas. So they're typically government-type loans, which are more or less FHA mortgages or also low down payment conventional financing. And then there's something also called jumbo loans, which are loans that are higher than $453,100. So jumbo loans have different down payment requirements, different interest rates, different underwriting criteria, different credit score requirements, because the lender is lending more money, so there's a little bit more stricter requirements for the consumer when they're looking in that upper echelon of price points.
Now, is this still in the FHA family?
They're not. So the FHA loan limit on a single-family residence is $379,500. So once the borrowing requirement is a little bit more than that, it would then have to kick into a conventional loan option. So those rules and regulations would have to come into play to bridge the gap between 379.5 and 453.100. And then after 453.100, the only loan option is called a jumbo loan, which then again, all of the rules and regulations of the lending practices are a little bit different in that price point.
Explain a jumbo loan to us, because a lot of people don't know what a jumbo loan is.
Sure, a jumbo loan is a loan that does not meet Fannie Mac, Freddie Mae, FHA, VA, or USDA lending guidelines. So when you get into the jumbo category, there are different loans that are out there with different down payment requirements, different interest rates, different mortgage insurance options. And typically when you get into the jumbo loans, again, that's over $453,100, the down payment requirements are greater, the credit score requirements are greater, the interest rates are not always higher, but oftentimes different. So it's different lending that's available, because these are not government-backed loans that have to all adhere to the same rules and regulations for every borrower.
What is usual the down payment on the higher end properties? I know FHA on the lower end, it's what, 3.5?
It is, correct.
Okay. On the higher end, what would that be like?
So if we're talking jumbo, typically the down payment requirement is 20% down. However, we can bridge the gap between 20% down all the way to 5% down in some cases. So we do have a couple different lending options where somebody can borrow 90% financing in one loan, where they can opt to pay mortgage insurance in addition to their monthly payment, or oftentimes maybe even take a higher rate and not have mortgage insurance. What we do a lot in the jumbo world are first and second mortgage options, where we would lend them 80% of the price in the first mortgage and then bridge the gap with a second mortgage up to 15% of the price, making up 95% financing. So even though somebody's buying at those higher price points, we still have the lending solutions to buy a home with as little as 5% down in some cases.
Wow. Now, what about the seller's assist? Does that still apply with the higher end properties?
It does. It's typically the same as a conventional loan, where if it's 20% down on the first mortgage, 10% down on the first mortgage or greater, you can get a 6% seller assist.
What is the credit score difference between a lower end and a higher end?
Sure. So with an FHA loan, we actually, as a company, will lend down to a 580 credit score. With a conventional loan, we will lend down to a 620 credit score. With a jumbo loan, our floor is a 680 credit score to get that type of loan.
No, that's not bad. I was thinking it was more in the 700s. And the jumbo loan, it's more for the higher end properties.
It's for the more expensive properties, correct.
Yeah. What are the most popular loans?
It's a difficult question to ask, because I do cover different markets. I work in 3 different markets. One, Center City, Philadelphia, which that coupled with its surrounding areas hits every target, from the low end properties in the $30,000 to $40,000 range, all the way up to the couple $1 million range. So you see every spectrum of loan option in that area. Another area that I cover is predominantly a first-time home buyer market. So you see more government financing with things like down payment assistance, with things like grants that are added into the loan, because in that area, the biggest challenge is coming up with enough resources for higher down payment options. And then my third area that I cover is more of a higher end area where, the price points are higher, therefore needing jumbo financing more so in the other 2 areas that I've mentioned.
I've come across questions about FHA and conventional mortgages, and one of them were, could they use FHA on a mixed-use property? And that's a totally different animal. Can you just touch on that for a minute?
Sure. FHA does permit mixed use with a subject property, but the majority of the property has to be used for residential. So if it's a building, the commercial space can't be any more than 49% of square footage of the total building, and the loan applicant has to live there as their primary residence. So that's not going to fit into every box for FHA financing. So that situation is permissible up to 4 units. Again, 49% of the total square footage or less is okay for commercial. Once it goes over that number, then it's ineligible.
And that's a property that has like a store downstairs, or somebody that wants to have a daycare, or a daycare that's already there.
Correct.
That's what you call mixed use. Now, 4 units could be 2 more units, in other words, in a duplex. That would still be considered residential. Is that right?
It would, unless there's a commercial store.
Right.
So it's the same rule that would apply whether it's storefront and 1 unit on top or storefront and 3 units on top. As long as the residential square footage is a majority of the building, that is okay with FHA.
And you would have to live in one of the units.
That is correct.
Great. What other type of loans are out there, like loans available for people in medical profession or other professions?
Sure. So we have a physician loan that enables doctors or residents to put very little money down and borrow up to a high amount of money for a particular property. So, we can help somebody that's buying a home in the $700,000 range with very little money down, which sometimes is appealing to people. So, if we have a doctor or that's looking for a home and wants to put very little money down, well, we have a solution for that. Where this loan is also nice is it appeals to residents as well, because there's a very liberal way to look at student loan calculation. So sometimes when somebody has too much student loan debt to qualify for a certain mortgage, this one might pick up the slack to enable them to qualify for something. So there's a different calculation that's utilized in order to count student loan debt for physicians or residents that might be a little bit different than other loan options that are out there.
Alex and I, we talk off and on outside of our podcast. So if you hear me say something about, you've said something before, and he also was on our podcast before talking about loans. However, this time we're getting a little bit deeper into the loans because there's so many different types of loans out there. And I do believe that people aren't aware of them and they should be taking advantage of these different types of loans. Alex, what advice would you give someone who is a first-time home buyer or not even a first-time home buyer? What advice could you give them to approach getting a mortgage loan?
I would just have them reach out to a lender sooner than not. Even if they know they're not ready to buy, I think the sooner they're in touch with a lender, the sooner they can get on the right path to purchase. So the best case scenario is they call a lender, they take the information, they discuss the comfort levels, and they come up with a price point, and they're ready to buy whenever they are. Or the worst case scenario situation, which I think is a great tool though, is person calls lender, they're not in a position to buy because of certain credit challenges or something that is not okay with their current situation in order to get a mortgage at current time. The lender is then able to put them on a roadmap to get them mortgage ready, whether it takes 1 month, 6 months, or 12 months down the road. That way, when the time comes and they are ready to purchase, they've already done the steps necessary to put them in a better position. If they wait till the time where they're actually ready to purchase, they may have another waiting period that they wish they didn't have had they would have talked to a lender 6 to 12 months prior. So I would say call the lender right away, know what your buying power is, know what your options are, or find out what you need to do to get into a better position. That way, when you are ready, it's a little bit smoother of a process.
I think that's great advice. What about for those who maybe can handle some credit problems immediately, do you offer any type of service, or can you refer them to someone that can deal with their credit problems?
A combination of both. So I am not a credit repair expert. However, being in the business for over 15 years, I know what helps people in getting their credit scores up. So that, coupled with some technologies that we have, I'm able to assist people through the recommendations of our credit vendor and the technologies that they have, guidance to improve their credit, to get to a certain score, to pay things off if necessary. However, if there are some credit profiles that involve people actually working on your behalf to eliminate things on the credit, dispute items, we do have several credit repair connections that we can refer them to. That way they can have somebody working on their behalf.
Do they call that like rapid scoring?
So rapid rescore is a term where something gets fixed to the existing credit report, and a rapid report is then produced immediately to change the things that were on the existing report and then give a different score based on the new information that's on the credit.
Right, and that usually takes only like a few days as long as you have proof of what you're disputing.
Correct. It's usually about 3 to 5 business days.
That's wonderful. Is there a charge for that? Is that something that the lender can refer you to someone?
It's something that we do, actually. So as an example, so let's say we needed somebody to pay down a credit card to get their credit score up. Person pays down credit card. They provide us the information proving what the new balance and new payment is. We then send that updated statement or letter from the creditor to our credit vendor. They then contact all 3 credit bureaus with the new information and provide us a new credit report with the new information, hopefully at that time with the credit score that we're targeting.
Oh, that's fantastic. So you can tell your prospective client, okay, well, if you pay down this credit card to a certain amount, then we can have you rescored and you can get the loan.
That's correct.
Fantastic. Tell everyone exactly how they can get in touch with you.
Sure. The best way to reach me is always my cell phone, which is 267-303-3368, or email alex.luboff, and that's L-U-B like boy, O-F-F, Frank, at phmloans.com.
Alex, thank you so much for again being on the show, and I look forward to you coming back. Thank you.
You got it. Thank you so much, Candy. I appreciate it.
You've been listening to Real Estate Today with Yvonne Candy. Don't forget to visit us on Facebook, Twitter, Instagram, and all other social media.